Welcome on board. We are so glad to see the progress that we are making, and it's such a great honor to have all of us attend this meeting. And tonight we have a guest who will be talking to us, teaching us about some of the things we are supposed to do before we place a trade. 7 must do things before you place a trade. But before that, let us pray. Father, once again, we come before you this good night, this good evening, this good day that you have given us, that we may learn how to become great uh, traders. And Lord, we keep on trusting that you're going to show us the way in becoming kingdom financiers, in how you bless us. We pray that you're going to enlighten us, going to guide us, even to trust us with monies that only you can give us. We commit our session tonight before you, that you're going to help us, going to open our minds, going to learn. We give you the glory and honor, and this is our prayer in Jesus' mighty name. Amen, amen, and amen. So, in a few seconds, we're going to go straight to our guest. Welcome on board.
So I remember when I first started trading, it was about 7 years ago. I was at work in a sales job and doing really well, as a matter of fact. And I remember one of my friends came into work. His name was Tom. Now, I'm not sure if I'm supposed to mention that, but that was his name. We won't mention any surnames here. And he came in and he said, "Have you heard about this trading thing?" I was like, "No." Well, actually, I did say yeah, to be honest with you. You know, when you just want to be involved? I was like, "Yeah, I've heard about it, but I haven't really dabbled in it." Then he came to me, sat down, shared some charts, and I think at the time he was sharing with me binary options. And I'm sure a lot of you have heard about binary options. Absolutely hilarious piece of whatever. Now, jumped into binary options, and I remember you could buy or put and sell, whatever it was. And when you're on the demo accounts, back then, binary was the way to go. Any trade you took, you was winning 9 out of 10 of them. But the minute you put money into the markets, that's when things went bad. So anyway, I was interested, but I realized coming from a gambling background that wasn't the kind of thing that I wanted to be involved in. You know, speculating with the markets going up or down, risking £50 to make, what was it, 50 or 150, whatever the odds were. So then I left it alone for a little while. Continued to just get on with my work, do my sales, make my money, and then somebody else came into work and they said to me, "Oh, I've just gone to this seminar and they've taught me how to trade, blah, blah, blah." And I was like, "Okay, so what's the plans now?" And he was like, "Well, I've paid £3,000 to join this seminar, and if I can prove over, I think it was 3 months or 6 months, that I can trade consistently, then I would be able to get a trading account." So I was like, okay, fine. People were willing to invest that far back. So I got a bit more inquisitive and I continued just to study, look at what I could find. Back then, the internet wasn't as exposed as it is now with the amount of information that's there. But I managed to find a book called Naked Forex by Walter Peters. And this was the book that really changed my trading forever. Started to study it, understanding different key levels, different candle patterns, and just different names of the currency pairs and the structures, etc., etc. And I dabbled with it a little while, you know, downloading MT4, seeing what it's about, blah, 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 blah. But at those times, when you're trading, the candles just look like literally trying to find a needle in a haystack. So I was on an ad hoc basis, dabbling between trading, not going live yet, just demo trading and binary. And then it was this moment that I went to a friend's house and I walked into his office and he was sitting there and he was downloading all these documents or all this data onto a spreadsheet. I said to him, "What are you doing?" Now, this was a good friend of mine back then. So, you know, when you have good friends and they're doing something that you have an interest in, you kind of feel more inclined to be, you know, more inquisitive. So I was, and I went and sat with him, asked him what he was doing. He said, "Oh, I'm trading." I was like, I'm a trader as well. You know, I'm a trader. So we sat down, he was talking about what he was talking about. I was talking about what I learned from the Naked Forex book. And yeah, it just started to build from there. And about 4 years ago was when I really transitioned my trading from learning, dabbling to really taking it seriously. And at the time, we were trading the 1 minute time frame, but super hyper scalping. I mean, like in and out of the markets within minutes. And we had some EAs that we were using as well. I'll put some up on the screen. Take a look at the email so you can see for yourselves. I still have the indicators. And funny enough, I think what we should do, YouTube, is we should pop these indicators on an MT4 platform and we should try them out. Maybe put £100,000 in an account and try it out together. I think that would be fun, but maybe down the line. But we got into it and everything else. Now, from there, you know, the rest is history. I continue to learn and adapt to my own, moving on to higher time frames, day trading, intraday trading, scalping, swing trading, you name it. Now, what's the moral of the story here? Well, the thing is, there was so much learning that I did throughout my transition as a trader, learning binary, scalping, intraday, swing trading, and there's such vast amount of knowledge out there on the internet that it can become super overwhelming. Now, they say in life, knowledge is power, but I say in Forex, too much knowledge is poison. So the topic of today's lesson is 5 things for you to consider before taking a trade. So what we're going to do today is share an example of a trade that I took on pound JPY, and I'm going to break that down to you. But before we do, I'm going to go through 5 steps that you can use in order to help you become more consistent and profitable with your trading, having a clear plan and direction about why you want to take the trade, how you're going to take the trade, and how you're going to enter and manage the trade, whatever else. So we're going to construct a plan. Now, the first thing we're going to talk about today, which I think is one of the most important factors when it comes to trading, is identifying the structure of the market. Now, what do I mean by that? Well, in Forex or in trading, period, there are only 3 structures that you're going to be working with. You're going to be working with an uptrend or a downtrend, a ranging market, or you're going to be deciding whether you need to trade within a range or not. Now, in terms of ranges, they're very messy. So we'll discuss that and we'll share some examples on the charts in a second. But the third point, should I say, is are you able to identify the direction of the trend within a few seconds? Let's head over to the charts and take a look at what we're seeing here. So we're going to take a look at our first example here. This is on Euro USD on the 30-minute time frame. Now, one of the criteria when constructing a plan and looking for identifiable trades, or should we say approaching trades, making a plan, is trying to figure out the direction of the market. Now, it sounds simple. Is it simple? Well, you know, that really depends and it's down to the trader here. But what we're looking for the market to do is clearly identify a bias. Now, we know when the market is moving to the upside, we make higher highs and higher lows. The markets break previous structural highs, they make new highs, they make higher lows above the previous structural highs, and continue on, so on and so forth. Now, the point here is this. If you come to the markets, the first thing you should be doing is identifying the direction. If the structure of this market is clearly moving to the upside, then your first thoughts should be this. Today, on Tuesday, on Wednesday, on Thursday, the market structure is bullish. Today, I am taking buys only. That is it, guys. There is nothing more to it. When formulating a plan, I'll say it again, you identify the structure and the directional bias and you stick to it, no matter what. Because the minute you start to deviate and you start to look for wick rejections and exhaustion trades and resistance trades and supply and demand trades and whatever else trades you've got out there, that's when you start to involve emotions. It's easier to lose a trade when you've planned the trade than it is to take a trade you think is a good trade and is not a good trade. You have to listen to that again. This is the first example, a clear uptrend. When the market is moving down, an example here on Euro New Zealand dollar 4-hour time frame. So for you guys out there who are making excuses, oh, I don't trade the 30-minute time frame, I'm only trading the 4H time frame. Well, here you go, 4H time frame, 30-minute time frame. Euro New Zealand dollar, a different pair. The market is clearly trending down. When you come to the markets in the morning and you see the structures creating lower lows and lower highs, your plan should be to sell only, period. Remove any other thought process that you may have, any other hurdles, obstacles, anything that you may be facing in that brain of yours, and just focus on sales. Because if the market is down, you're more likely to win your trades or have a higher probability of winning your trades working with this downtrend and selling only. Because if you buy it, guess what you're going to say later on? Oh, guess what? The market was down and I knew I shouldn't have bought it, but I did because it looked like a buy, but now I look at it again, it's a sell. You don't want that. Remove it. The final example of the first step that we need to be focusing on in formulating a plan or constructing a plan is identifying ranges. If you cannot look at the charts from a 10-year-old's perspective and identify immediately a trend that's either up or down, then guess what? Identify it as a range with no directional bias and stay out. Don't fight the markets. Don't be the brains behind the first person who can enter a trade and say, well, it's making lower highs and lower lows. If it's not breaking structural highs and it's not breaking structural lows, guess what? Get out the markets. So that's the first part of your plan. Identify the directional bias. If it's up, you're buying. If it's down, you're selling. And if it's moving sideways, you're doing nothing. Pretty simple. Put it in a notepad. Remember this point. So for the second point is marking your key levels. You want to make sure that you're marking your major level, your intermediate levels, and then your target levels. So we're going to look at an example right now on New Zealand dollar JPY on the 30-minute time frame. First part of the planning was identifying the structure of the market. This is clearly making higher highs and higher lows. So what are we doing with this example? Well, we're buying this structure, or we're buying when we get an opportunity. Now, in terms of key levels, what's your major key level? Well, if you're buying in an uptrend, your major key levels are always going to be your higher lows. Why? Well, in an uptrend, as we saw recently, if the market is making higher highs and higher lows, then after a higher low, we expect a higher high. Only until the major higher low is broken are we anticipating or potentially waiting for the trend to change here. So as long as the market is respecting this structure, it is not being broken, then we are still looking for buys. The only time we're not is when the market breaks the structure. So when the market comes back to our major key level, which is this one here, we then have to wait for evidence and confirmation of the market showing or giving us a sign to take a trade. What do we have here? Well, we have price creating multiple wick rejections, indicating bullish sentiment. We also have wick rejections here, indicating bullish sentiment. Now we need an intermediate level. Our intermediate level is always going to be a level in the market where price has created some sort of resistance. When I say resistance, I don't mean resistance, let's sell in the market. I just mean resistance period where you see multiple wick rejections. Why is this important? Well, we'll get onto that in a minute. The final level that you need to be looking for is your target level. Why? Well, everybody needs a target. If you take a trade blindly and you don't have any direction of what risk to reward ratio you're using, when you're going to take your profits, how you're going to manage your trades, this will help you. Okay? So you have your major level, your intermediate level, which we're going to talk about in a minute, and then your target level. So now the market's come back to a key level. We see the wick rejections here. We're going to take the trade. This is an example, so don't start putting messages underneath this video and be like, oh, Rox, you made replay mode, I'm not interested. Just take some of the principles and concepts that I'm illustrating here so that you can use it in your own trading. Wick rejections at a key level, structure is up, we have evidence and confirmation, now we're taking a trade of the break of the structure with a buy stop order. Why is the intermediate level important? Because we need to see if we can get to break even by 1-to-1. Okay? By the time the market moves 10 pips, we need to make sure we can get our trade to break even. Remove the risk and let the trade play out. Now, do we have a 1-to-1 back to this intermediate level? Absolutely. We're good to take the trade. The trend is up. Are we good to buy? Absolutely. The next point will come after, which should have probably come before, but let's focus on this now. And then we have the wick rejections. Targets, we're going for 1-to-3 as part of my strategy. Are we going to be able to hit our targets before we find some sort of resistance at this major key level? Target level, 1000%. What do? We take the trade and then we see what happens. Okay? This is what we call Bob is your uncle. We plan the trade, we identify the structure, we see how the market is moving, and there you go. Okay? What did we do? We identified the structure, step 1. We marked our key levels, step 2. As you can clearly see here with this example, this is how you want to do it. Major key level, intermediate level, make sure you can get to break even and manage that trade, and finally target levels, as you can clearly see here. So we've discussed 2 points already. Identify the structure bias of the market. Second, mark your key levels. Now third, identify the phases of the market. Now these are, in my opinion, the holy grail rules of Forex trading. Now, if you're not familiar with it, then you're going to get familiar with it now. But there's a few rules we must stick to as traders. We know how an uptrend moves, higher highs and higher lows. We know how a downtrend moves, lower lows, lower highs. We know how a range moves, sideways. But when should we buy and when should we sell? Well, here we have the examples of when we should do that. First example is a downtrend. We never want to sell the market when the market is in a push phase. Why? Well, even though the market is moving down, and we may get signs of wick rejections and engulfing candles and strong momentum to the downside, we always run into or may face the issue of price pulling back. So if we enter in a push phase, what could happen is when we plan to sell the market, no matter what evidence or what confirmation you get, there is a very high chance that the market will pull back. So how do you eliminate this? Well, when you identify the market has made a lower high and already has broken the previous low and extended itself beyond the previous structural low, that's a sign to stay out. Wait for the market to breathe, as I want to call it. Wait for it to exhaust and then look to take the trade. Once the market has exhausted from the push phase, that's when you can start looking for trades. Why? Well, after a push phase, we have an exhaustion phase. And after the exhaustion phase, we then, in theory, have a continue push phase. That's the same with a buy-bias structure. If the market is trending up, we know we're looking for buys, but we don't want to buy in a push phase because there is a very high chance that the market, when trying to buy, will eventually do what? Exhaust. Now remember, with our key levels, as long as the market trades above the previous high or low, we're still good for buys. And you don't want to be in a position with those excuses that we hear out there. Oh, the market makers took me out. Oh, it was a stop loss hunt. Oh, that was my broker. Get out of here. I'm teaching you the rules of trading right now. These are all you need to know. If the market's in a push phase, wait for the exhaustion. I couldn't care less, and you shouldn't care less, respectfully saying, if the market exhausts and you think it's exhaustion, as long as it looks like the exhaustion and you take the trade and it loses, then guess what? It was a banging trade. But if you're taking a trade at a push phase, then you're a donut. Now, when do we want to buy and when do we want to sell? Well, we've just said it here, to be honest with you. But if the trend is down, we're looking for sells, and we only want to sell once the market has exhausted or pulled back, because based on past history, and always remember this, without history, there's no future. If the market has pulled back, created structure in the market, what can we expect? Well, we can suspect that the market will then eventually create a new lower high. And if we're taking our trade in an exhaustion phase, we can suspect a continuation as part of the downtrend. Same applies to buys here. If the market is in an uptrend, we know we're looking for buys. As part of an uptrend, what comes after a pullback higher low? Well, obviously, a continuation. Not guaranteed, but more often than not. And if we're trading based on structure, the market trading above the levels, trading as an uptrend, then we could suspect the market will eventually push the upside to make a continuation of that uptrend. So very simple concept here, but a lot of traders, should I say, overlook this. These are the rules to trading. There's nothing more to it. And if you can accept this concept and believe, this is going to make a huge difference to your trading in 2021. Final point here. When the markets are ranging, guess what? Just stay out of the market. Don't be an absolute George. You only want to trade when the market is pushing up or down, is in an exhaustion phase, has retested key levels, shown signs of wick rejections, giving you evidence of momentum. When the market's doing nothing, you do nothing. Get a book, go on YouTube, go for a run. Just don't trade. Not every day is a trading day. So that's tip number 3. Identify your market structure, identify your key levels, and identify the phases of the market. Because these 3 tips alone is enough to make a huge difference. But let's move on to tip number 4. Tip number 4, identify your patterns. There is nothing worse than a trader trying to trade absolutely everything. Listen to what I'm telling you. If you want to be a successful, consistent trader, you only need 2 or 3 patterns. To be honest, you only need 1. Trading is about being patient, waiting for the trades to come to you. The more you know, as we mentioned in the beginning, the harder it is going to be for you to execute because you're going to continually have doubts. But what you need to do as part of formulating your plan is making sure you know which patterns you are going to trade. Now, these patterns here are not new. You all know them. I'm not trying to teach you anything that is going to change your life here, but I'm trying to illustrate a point. Once you've identified the direction, you've formed your key levels or drawn in your key levels, you understand the phases of the market, that's your foundation. You're ready to trade. Now, all you're doing is waiting for those 3 things to line up, and then, once your pattern develops, looking to take a trade. Now, these are some of the patterns that I trade, which I love. As you can clearly see here, there's no butterflies or bumblebees on this chart. There's no order blocks or supply and demand. There's no A, B, C, D, E, F, G on here, or 1, 2, 3, 4, 5. It's simple. In a downtrend, if the market creates a double top, I'm taking it. Why? Because a level's created. If a level's being respected as part of a downtrend, there's a strong sign the market could go down. As a double bottom in an uptrend, if the market creates a level and a level's respected, there's a very high chance the market can go up. Now, does this mean it's going to win? No. But if I'm 30, 40, 50% right, I'm making money, baby. So if I see this pattern as part of an uptrend, I'm taking it. Break and retest. Again, downtrend. If the market's making lower lows, lower highs, and after the push phase makes an exhaustion phase, and I get evidence of a retest at a key level, guess what? Taking a sell. Why? Because after a push phase, we have an exhaustion. In a downtrend, an exhaustion, if it creates a lower high, will then eventually create what? A new lower low. Same for an uptrend. Triple bottoms, triple tops. Amazing patterns. Usually I like to take these when the market is coming from a downtrend. Then this pattern here illustrates price failing to break structure, indicating a potential reversal. I'm not taking a double bottom as part of a downtrend. I will only take a triple bottom as part of a downtrend reversal into a buy bias market, because then I have 3 confluences. A level created, price making the lower high, failing to make the lower low, failing the double top, making the triple bottom, 3 confluences, buy. Same with triple tops. Now these patterns might not be for you. As I said, some of you are into some of these really fruity patterns, and some of you into some of these simple patterns. But for me, I am a simple pattern person, trader. And you need to identify 1, 2, or 3 patterns you're going to work with. I promise you. You may not be taking as much trades as you are now, but I can promise you one thing. You will become more consistent with your results and the outcome of your trades. You will allow the numbers to play out, and trust me, things will change. So, structure, key levels, phases in the market, and patterns. Okay? So there's 4 there, and for the final one, it's an accumulation of the 3. So, let's take a look at my pound JPY trade that I took yesterday, and let's focus on the 5 points that we just discussed. So the first thing we want to do here when planning this trade is identify the direction of the market. Now, granted, looking at GJ is not the clearest of trends here, but with experience, you'll start to identify how to identify trends on higher time frames and then be able to understand what is happening on a lower time frame. Now, as an intraday trader, from a 4H perspective, I'm not really too fussed about this trend here. What I'm really focused on is what's happening here. So when we go down to the hourly time frame, you'll see this more clearly. What do you see? A beautiful uptrend, higher highs and higher lows. But then you might ask yourself, well then Rox, why do you have the key level from the 4H here at the highs and the lows? Well, remember what I said. We have 3 levels. You have your major level, which is this. Clearly, this is a very important level in the market. Then you have your target levels, and then you have your intermediate level. So in a minute, we'll go over the intermediate level. The thought process yesterday, let's go to the hourly and focus on this from an hourly perspective, and let's find our notes. I'm looking at the direction. The trend was up, making higher highs and higher lows. So we put a little tick there. We have a key level that we need to be careful of, the 4H key level. As you can see, when price came to this level, it failed to break above it for a long period of time. So I'm looking for a higher high, higher low formation here. I'm looking for price to respect levels in the market where it's holding, where there's multiple wick rejections, just like this key level here. And then what I'm anticipating the market to do is make a new higher high. So the direction is up. My key levels are in and around here. And what I'm expecting the market to do is eventually make a new higher high. Now, if the market is in a push phase, I expect it to do what? Pull back, respect structure, then make the higher high. But if the market exhausts and doesn't continue and then eventually starts to break structure levels in the market, closing below those levels, what can I start to anticipate based on this criteria? Well, the direction is potentially changing, my key levels are being violated, and the phase of the market is now changing to a push phase, but in an opposite direction because structures are being broken. Now the plan was, and if you want to see the live recording of this plan, I'll pop a link down below and you can go check out my Facebook of the live recording. But the plan was, from the live session, to wait for a 4H candle close. Only until this 4H candle closed would I be looking for sales. The minute that 4H candle closed, this is what I did. I went down to my 5-minute time frame. So this may seem confusing, but don't get confused. Previous uptrend, high time frame. Key level, 4H time frame. Structure of the market holding at my key levels, looking for a continuation higher high. Terms of patterns, probably not looking for any patterns here. Waiting for a clean break and retest. But then we have a structural change. Price started to break the structure on the 4H time frame, taking out the trend line / what I like to call brick wall, destroying and crushing through key levels in the market. And then we have a new form structure that is forming lower lows and lower highs. Now, when we're looking at the structure, we want to look for patterns as part of our trading opportunities. So when we're looking for these patterns, I'm taking my major key levels in the market, as you can see here. Let's remove these and these. Once the market makes a lower high and a lower low as part of this downtrend, I'm then looking for price to pull back. So this usually would be in and around this level here. But remember what we mentioned in the beginning of this video, as long as price trades below the key level, we're good to go for sales. So we don't really call this a break, we'd just adjust it as price develops. So price comes back to this key level. Some of you might be saying, well, Rox, if you're looking for your patterns to take the trade, then is this not an opportunity to sell? Well, no, not really. I'm looking for a bearish candle. I'm looking for indecision, or I'm looking to trade this as part of a sell stop entry. So I'm waiting for 2 3-wick rejections. If they develop, I'll take the trade, and if they don't, I don't take the trade. Nothing developed here, and I think at the time, if I'm being brutally honest with you, I wasn't looking for a pattern. By the time I got to the charts, what I identified was the breakout and the break back in. That's another pattern for you. Price then done what? Continued the push phase as part of this overall downtrend, created what I just mentioned, which was multiple wick rejections, indecisions, wick rejections, whatever else. And now we start to form what? A continued downtrend. So at this stage, how did I take the trade? Well, I'm identifying here, the market's creating a downtrend structure. The bias is sell. The key levels are being respected. Higher time frame key levels are being respected and violated, changing the direction of the market. The phase of the market has been in a strong push phase, double top pattern, pulling back, creating multiple wick rejections, and my pattern now is a lower high trade as part of a downtrend, anticipating the new lower low. What I did at this stage is I waited for price to push back into around 50% of my stop loss range, giving the market the opportunity to push up, and if it did, no trade. But once it's pushed up, I then set my sell stop, so if the market does continue down, I get triggered in with momentum as part of the structure, as part of my pattern, in respect to my key levels, and look what happened. I was triggered into the trade. Break even was set at 1 to 2, which I never got, which was around here somewhere. As you can clearly see, we sat in this trade for a little while. We had a pullback, and then towards the end, as you can see here, the market continues to rally down. Now, as you will continue to see, the trend line, or the brick wall, as I like to call it, is being respected. New lower lows and lower highs are being formed. Previous structures are being violated. Key levels are being respected. Double top patterns are forming. There are so many opportunities for you to trade. What's the final point? Bring it all together. It will take practice, but I tell you, over time, you for sure will be able to master your charts in a very similar way and find a lot more consistency with your trading. So just to conclude this, why is it important to plan your trades and use this 5-step process to make sure that you are being the best, or doing the best that you can, to find the highest probable setups and to start trading more consistently and profitably? Well, making a plan and trading these 5 steps will stop you from trading off the whim. When you make a plan, you have a clear direction, you know what it is you're looking for, whether you lose a trade or not, guess what? You're going to be satisfied with the result. It's going to stop your failure in this business like everybody else is doing. You'll be able to focus on, or have laser focus on, what it is you are expecting from the markets. And to be honest with you, one of the biggest things that I've seen, if you use this 5-step process and you really focus on your approach to the markets, you're going to remove all emotions. You will. It's just natural. Because to be honest with you, when you know what to expect, whether it be a win or a lose, you know that you're using a strategy that's proven, is part of your plan, you have data to back it up, and you're executing according to that plan, that approach, there's nothing to be worried about. You remove fear, you feel more confident, you're able to just execute and compose yourself in the live markets. And to be honest with you, If you know how to do this approach and you practice it on a daily basis, because it won't happen overnight, but if you continue to practice it, guess what? It will stop you making bad decisions. And bad decisions is the reason why traders fail. One of the biggest reasons. So my advice to you is this. Watch this video over again. Take some notes. Make sure that you practice this, because it's not going to, as I said, happen overnight. Go and backtest 25 trades, 100 trades, and make sure that there is a story behind every trade you take. If you take a trade just because it's a key level, there's a pin bar and engulfing candle, it's not the right reason to be taking a trade. Make sure you know why you're taking it. You know, like people are able to talk about football players, their names, their surnames, their age, their date of birth. Like, it blows my mind. I mean, good on you, to be honest with you. But how they do it with football, how they do it with basketball, how they do it with NFL, whatever you want to call it, you should be able to do it with your trading. This is your business. This is your future. Take it seriously.